Welcome to Electrified. It's your host, Dylan Loomis. First up today, a feature I know many of you will be excited about rolling out in 2023.12.1. Now you can just, on the Model 3 and Y, hit the wiper button on the stock, and then you can adjust the speed by clicking the scroll wheel on the left to the right or left. If you've been in any Tesla forums in the past, you will know this has been a feature that many people have been requesting. Also, in an upcoming update, it looks like Tesla is bringing back the low regen mode option on some newer vehicles. Yes, this has been removed, but on some of the older vehicles, it was never taken away in the first place. So looks like it's coming back to the vehicles that lost it. Corey and Sandy just finished a tour at Giga Berlin, and they couldn't film, but they saw some stuff, including a 4th gen rear drive unit where you could see the integrated filter, and they said 4 gigapresses in action. I would imagine we'll get a full video on their findings in the weeks ahead. From the driven, we have Queensland, which is in northeast Australia, looking to push for more EVs on the roads, deciding to double the size of rebates for EVs from $3,000 to $6,000, and will be available for households with income less than $180,000 per year. As you can see, now Canada has the rear-wheel drive Model Y available for under $60,000. And yes, for SUVs under the MSRP of $60,000, that means they're eligible for up to $5,000 in the IZEV incentives. And actually on the Tesla website, if you highlight the long-range variant, Tesla is saying that that design also qualifies for the $5,000 IZEV incentive if you're eligible. What's interesting is that in Canada, where you would think more people would want an all-wheel drive version, that's where Tesla is now offering a rear-wheel drive Model Y. And if you convert the range to miles, this is only about 244 miles of range compared to the base or the standard all-wheel drive Model Y in the States, which gets 279 miles. So it's possible this Model Y is using the same LFP cells that the standard range Model 3 has been using. It doesn't necessarily mean this vehicle has to be built in Shanghai and then shipped and imported into Canada. It could also come from Fremont, but too soon to say. And what's nice is that in regions like Quebec, there's also an additional $7,000 rebate for people in those regions that was extended until 2026 to 2027. So at the end of the day, it's great to see Tesla offering more options for the Model Y in different regions. Again, they have the data, and hopefully these distinctions will be part of the reason the Model Y becomes the best-selling car of any kind globally this year. I did just want to reiterate some of the updates that may have been overlooked in the bigger narratives from yesterday. So 4680 is of course crucial to Tesla's future. Talking about the cathode facility in Austin, they're at 50% equipment and 75% utilities installed, and they're expecting to produce the first cathode material before the end of this year. Then when it comes to 4680s and specifically the structural pack, they're talking about 50% lower capex and 66% smaller factory for the same output in gigawatt hours per year. So for Tesla to reduce battery pack manufacturing capex by 50%, I like what I'm hearing. And in Q1 for the 4680 team, Texas production of 4680s increased 50% quarter over quarter, through yields increased 12%, and the team accomplished a 25% in the reduction in cost of goods sold over the quarter. So all of this paired with the fact they said they're already working on a second generation 4680 cell that's easier to manufacture, I thought we got a really nice update on the 4680 progress. Now we have Tesla actually increasing the price on all variants of the Model S and X by $2,500. In tandem, they're now offering 3 years of free supercharging if you buy a Model S or X. However, this promotion is set to end on June 30th. Could this be a chess move by Tesla to try to get consumers who are now waiting further price cuts for the 3 and Y to maybe be a bit fearful that prices of those vehicles could go back up, giving them more incentive to purchase it now rather than waiting? Maybe, or maybe it has nothing to do with the 3 and Y and everything to do with Model S and X supply and demand imbalances that they're looking to fix. So here you have those updated prices for the S and X, and you can see since the beginning of this year, on average, those vehicles are still down about 20% from where they were. And maybe now that the refreshed S and X are available again globally, the order rates have ticked up. Specifically, I'm thinking about China, as these deliveries had just started, so that could be what's driving the increase. ARK Invest put out their updated Tesla stock price target for 2027. They have a bear case of $1,400 per share and a bull case of $2,500 per share for an actual target of $2,000 per share in 2027, which, yes, is more than a 10x from today's levels. And they said they did not include anything for Dojo training as a service or Tesla's Optimus. For Tesla to reach a $5 trillion market cap and beyond in the next 5 or so years, that of course will hinge on Tesla solving full autonomy and deploying robotaxis at scale. Simply put, the way ARK Invest comes to these numbers, they run millions of different simulations using a Monte Carlo model. So what they're showing here is the percentage of those simulations that indicate Tesla's first year of robotaxi commercialization. So no, this is not at all a representation of what the chances are for Tesla deploying the first robotaxis. It's really just saying in a roundabout way for ARK's price target to come to fruition or remain on track, about 63% of their simulations are requiring Tesla to launch commercial robotaxis by 2024 or 2025.
That is what we're saying. We think that the robotaxi opportunity globally will deliver $8 to $10 trillion in revenue by 2030 and is one of the most important investment opportunities of our lifetimes.
Okay.
And I think one of the reasons for that is it is going to save lives. 80 to 90% of auto fatalities and auto accidents are caused by human error. And autonomous driving is going to take away the human error, we believe.
So they're definitely bullish. This report will be linked below, but I just wanted to highlight the difference between this and most of Wall Street price targets. Of course, Wall Street does price targets for 1 year into the future, but they're not really modeling much of anything for FSD, whereas ARK's price target is very heavily weighted and reliant upon FSD and robotaxi. So definitely a stark contrast. For whatever it may be worth, back in my modeling days, I would be somewhere in between. This morning, Toyota came out with a new 3-step plan for its EV strategy, but we don't really get any concrete detail of how they're going to pull off all of these major changes. All we get is it will be a different concept from what they've had until now, and sometime around 2026, they look to have a completely new EV platform. Like many others, they're now touting doubling their range and cutting the costs in half, but the real question is, how are they going to do this? Toyota is targeting EV volumes of 1.5 million in 2025, basically where Tesla was last year, and then 3.5 million globally by 2030. Pretty interesting though. Who does this sound like? They're talking about a structural body, a new operating system, and software services for their Step 3 vehicles in this EV transition. So can Toyota go from selling around 25,000 full EVs last year to 1.5 million in about 3 years? We'll see. Jim Farley commented on Tesla's price cuts, saying they're completely rational and should surprise no one. Price wars are breaking out everywhere. Who's going to blink for growth? And a simple summary, the price reductions create challenges for rivals who have not established supply chains and vehicle production as advanced as Tesla's. On that note, I just wanted to touch on this chart from Tony Sacconaghi, basically now trying to say that Tesla's EBIT and gross profit margins of 9.4 and 19% respectively are now basically in line with the rest of the industry. Here's the problem with this though. most of these numbers are all based on ICE vehicles. So sure, some of these companies can eke out a decent profit making combustion engine cars. But if it's true we're all going to a future of 100% electric vehicles, well, I can tell you right now, these numbers would look very different if their EV businesses were separated out like Ford just did. So my point is not a new one, but as demand for these ICE vehicles slows and EVs continue to gain more market share with the Inflation Reduction Act, these profit numbers are going to come down for their combustion businesses. And given that they're being forced to switch to EV production, that's going to further put pressure on their margins. So in the years ahead, we'll start to see what these numbers are really going to look like when all of these companies start to break out their EV business lines. And isn't that really all that's going to matter, again, from a long-term perspective, if that's where we're headed? You can find me on Twitter at DylanLoomis22. Hope you guys have a wonderful and a safe weekend. Please like the video if you did, and a huge thank you to all of my Patreon supporters.